John Gatewood, founder and CEO of Gatewood Wealth Solutions, where we are on a mission to help individuals and families become and remain financially self-reliant. Welcome back to our weekly Market Insight broadcast. And as usual, we have our Chief Investment Officer, Aaron Tuttle. Welcome, Aaron.
John, I'm glad to be here. I see you have trees behind you. I have trees behind me.
My trees are probably a little greener because I'm down here in Florida where it rains every day of the week, at least from now through September. So
I think we're getting some of that rain too here.
Well, today is the last day of the month, and it looks like we're going to end the month in a gain position with the market. So this will be the fifth month this year so far. And that leads us into today's topic, which is, are we at the top?
They never ring a bell at the top, so I'm not sure. But as you were saying, if I can get my slides to move, next quarter or next time we meet, we can go over what has happened over the quarter, because this is the last, not only the last day of the month, but the last day of the quarter. So we'll be able to go over and just take a moment to pause and see what are our predictions, what worked, what's come true, what has not. But let's get to that question on kind of the seasonality. What season are we in on the market? And this chart is really looking back over the last 10 years at each individual month. And it's looking at the S&P 500 for this one, and how consistent is it higher at the end of the month from where it began. So it's a positive month. We can see January, 50% of the time over the last 10 years, it's made progress, and 50% of the time it's actually lost. And then we get into April, May, June. And if we look at that and compare it as a quarter, that's actually the best quarter based on seasonality. Now, notice July is up. 89% of the time, the S&P has been positive for the month of July. And if we look down below, it actually is the one minus November. It's the highest month seasonality. And then we get into August and September and really October. And if we were to go back further, people would see that September, October are the months with the highest likeliness of a correction. And we think there's an economic explanation for that.
So how should we look at that? Because it seems as though if we're entering into July, is that going to impact the decisions that we make, since that's tends to be a higher month, and then we have 3 months in a row where they have more of an opportunity of being down?
Well, there's certainly an old adage to sell in May and come back and say on St. Ledger's Day, which is September 15th, because of the frequency of corrections, especially sizable ones over that time period. October has had a lot of months, so I don't think you necessarily miss out on that. But that wouldn't be something that we would advocate, because majority of the time in this scenario, we still actually have positive months, right? 56% of the time, August, September, October, the S&P continues to move up and be in positive territory over the last 10 years. So this is known as technical analysis. Once again, we think there's an economic reason that corrections happen in October, but this doesn't really tell us if we're due for one or not. And we can also look at the same chart for the Qs, which is done very well. And if we look at July, it's up 4.1% on average over the last 10 years. At 100% of the time, it's ahead. Now, there's two ways to interpret that. It's that, well, it's up 100% of the time, so there's no reason to worry. Or it's been up 100%, we're due for a correction, right? It's the gambler's fallacy. It hasn't been on black, so it's got to hit black now.
Just so our audience knows, so the Qs refer to the top 100 companies, correct?
Top 100 in the NASDAQ, yes. So over the counter. It tends to be companies like Microsoft, Amazon, Google, some of those larger names that started on what's known as the OTC. But yes, they've done most of the appreciation really over the last couple of decades. So if you've been in the NASDAQ, specifically the NASDAQ 100, you've done well. Now, the question that you're asking is, well, Aaron, we've had 12 actual consecutive months of positive months. How often does this happen? It's not that often. If we go back to 1957, it's happened 6 times. But there isn't a magic number that says, well, now that we've hit 12 months, we got to sell off. And it could be a single month that is a 0.1 negative %. So if we look back in 1988, that was actually the longest consecutive winning streak of 18 months in a row. But what if we were to go back and just say, well, each of those winning streaks where we went over 12 months, is it a good idea to put money into the market now or not? And this graph shows that if we go out 12 months from a 12 consecutive month positive run, majority of the time, or actually all the time in the historical data, you're actually higher 12 months later. Now, there's one example where it's 101,000. So this is not a 1% return is nothing that you're writing home to, but we also have a 23% return. So it doesn't mean that you should just abandon the market because we've had a long string. Actually, if any indication from the phenomena known as momentum is that it's more likely if you've had strong consecutive months that you'll continue to have consecutive months. Obvious with the caveat that at some point it does end, and when it ends, it no longer works, right?
Well, I think that a good point too here, Aaron, is that under none of those circumstances was there a negative return at the end of that 12-month period of time.
Correct. And markets tend to correct quickly. We spend most of the time in an upward trend, even if valuations are high. Now, another thing that we could do is we can measure the volatility of the market. What's the likeliness of a correction coming up? And whenever we're doing that, we look at what's known as the VIX or the VIX index. A lot of people will call this a fear index. And this is basically measuring options. So calls and puts. And now what's a call? A call is something that if I own a stock, let's say I own AT&T, and I want to sell the right to somebody else to call it away from me, I can get paid a premium. And then if the stock appreciates to whatever that call contract is, let's say AT&T is trading at $50. This is a hypothetical. And I sell a call to you, John, at 55, and you pay me $2 for the right to buy it back at 55. If it then moves up to 56, that $2 allows you to call it back, and you're able to get that and pay me $55. So you wouldn't do it at 56, you'd probably do it at 60, where you have $5 of surplus. And the longer that option lasts, the more valuable it is, right? So if it only is going to last one day, the chances of it exceeding your call, your strike premium is low. But if it lasts 3 years, well, it's pretty high. And so then the last thing is the probability that it'll actually move up. So if you're in a utility stock, the chance of it, let's say, going up 20% is pretty low. So there's not going to be a big chance that option's not going to be very expensive. And that is measuring the probability, or really the volatility of a stock. How much will it go up and down over a given period of time? And then we can basically look at what options are trading for on the market. And we know the strike price and we know the time duration. So if it's moving up and down in value, we can actually measure the probability of the market moving a lot, specifically on the downside. And that's what the VIX does. It takes all that complicated math and just says, let's just measure the volatility. And if we see spikes, like we're looking in this chart, if it moves up significantly, where it's a 20% spike above its 10-day moving average, we consider that warning of fear, that the market is actually pricing in a lot of concern or the chance of the market going down. And since April of 2020, the VIX has been trending down. So the options in the market are trending in a way that it doesn't look like there's a high probability of a correction at the moment. Now, if traders were to begin to think that a correction is likely, they're going to sell calls and they're going to buy puts. That's going to change the price of those securities to the point that it's going to make it look like the probability of a correction is going to be there. So it's the actual hedging that would indicate in this indicator that the likeliness of a correction is coming. And so far, it has not been there. But you can see that the spikes kind of just come up and all of a sudden they show up. And then whenever we're in that, another thing that we like to look at is the VIX versus the VXV. There's no test. I don't expect anyone to pass this quiz after this. But what we're saying is there's a short-term pricing option, let's say 3 months out, And then there's an intermediate where it's 3 months to, let's say, 9 months. And all we're doing is we're dividing the short term by the long term or the medium term to see, is the market pricing in fear in the short term versus long term. And this has really helped us a lot on adding cash to positions or when to raise cash for cash hubs. Because we're above that green line, what it's saying is there's an enormous amount of fear in the market, but it seems that it's going to pass within 3 months. So that's probably a good buying indicator whenever the market sells off and we're up above that green line. Now, the other side would be that red line. Now, this is not so much a bearish indicator saying that the market is overvalued and it's excessively greedy. Though there's truth to that, it's going to correct probably whenever you're in that area. It's really, should we be raising cash to fill our cash bucket? Do we take money off because the risk is that the market's probably a little overvalued, a little too bullish in there? So we use this as an indicator on whether it's a good time to put money to work, what's the likeliness of a correction to happen based on real price movements where people are putting real dollars to work, and also is it a good time to raise cash to fill that cash up?
So let me just interject for a second. So if I kind of summarize these two things, when you look at the volatility on the options index, okay, that's what people in that market are measuring, or what they believe that future volatility is going to be. And the higher the volatility, the closer the chances of potentially, now it's not a certainty, of having a correction in the market. So if we're looking at, even though with that first slide showing that August, September, October, it's kind of 50-50 up and based upon the indicator on the volatility index, there's a low likelihood of that would happen.
At the moment.
At the moment. Now that would certainly change. And of course, that's what our investment committee will look at. The other thing that was kind of interesting is that you look at the chart here, and we raised cash for our clients in the time period here when the market, when that green line was below the red line.
Yes. Yes. So this is a very helpful measure for us whenever we're trying to understand putting cash to work or actually taking cash to fill those cash buckets, as well as a likeliness of a market correction. And then another way to look at volatility, I think one a little bit more straightforward, it doesn't require exotic derivative and trying to back out the math to understand it, is simply looking at the first half. So 1H means first half of the year, and look for days that were plus or minus 1%. And if we look at this, we can see 2021 is actually below the average, that dotted line. So on this measure of volatility, we're below the average. We can see 2020 was significantly high. We got to go back all the way to 2009 to see a more volatile year. And so it was certainly above average. And then if we look at it and say, well, let's not make the plus or minus 1%, let's adjust to plus or minus 2%. We've only so far in the first half of 2021 had 4 days where it's plus or minus 2%. We had 39 in 2020 for the first half. And then once again, go back to 2009, that's a more volatile year where we had 45 days. Now,
it seems more volatile though. Because doesn't it seem like it's been more volatile this year than what these stats are showing?
Absolutely, it does. And Chris and I have gone back and forth on the daily 3x3. I don't know how many times we've said the roller coaster on the back and forth for value to growth rotation and growth to value rotation. It's been a very bipolar market. And if we say, well, let's not look at the S&P 500, let's separate growth, let's separate value out, and let's look at how often they were up plus or minus 1% in a given day. And we can see that we've been up 51 in both of those factors for the S&P, which is well above average. So what's happening is it's a teeter-totter. So we have up, down, and the value and growth have been very volatile. But if you look at the center, it seems like it's not moving. And so the days that we're up 1% in growth are the days that we're down 1% in value, and vice versa. So it's actually been very volatile if you pay attention to the growth value standpoint, which we do. For the most of the year, especially the first part of the quarter, it's been a value rotation, and we were growth. It's hurt. Now, tactical mutual fund, we've made some changes, tax sensitive. We weren't able to make a lot of changes because of the tax impact. Now, I'm happy to say that growth has reasserted itself in the second quarter, and we're still ending the quarter today. But it looks like most of our strategies are going to be at or above their benchmark for the second quarter. Now, we have not made up from the first quarter, but it's good to not lose any and actually make some gains in some areas. And depending on how the day ends, we could be a little bit further ahead.
Well, I can see how with this chart, it shows how difficult managing the momentum strategy this past year has been, simply because what we're trying to do is find where the trend is. And what this is showing is that the trend was flip-flopping back and forth. So the fact that you've done it as well as you have is really remarkable. But now we're hopefully seeing that the trends that will take hold going forward.
We believe that we are starting to see growth reassert itself. So if we get to the next slide, last week we talked about that dome, and we shared some concern that if we didn't break through that dome, we would go back to test the 50-day and then probably go further down. I'm happy to say that the market wanted to go through that dome, and there were more buyers than sellers when we hit that. So we've hit new highs and we broke that technical dome. Now, if we were to go back and we look at kind of the rate of change over the last 50 days on how much the market has been appreciating on a rolling 50-day, and we were up to near 10% back in May, and it had moved all the way down into the twos. So basically what's happening is that market has kind of consolidated, and it's taking a breather, is what a technician would say. And the longer it's trying to take that breather and figure out, is it going to go to the upside or go to the downside, the greater the movement will be whenever it happens. And this is technical, so we're reading tea leaves here, but they tend to be a good indicator of how much price upside and downside we have, a risk. The price objective, based on really being in a trading range for several months now, has a target of 45.60 on the S&P 500. It's whenever I did this screenshot, the S&P was at 42.96. So there's 300 points of excess or upside potential over the next quarter or so that could be realized. And then if we look, what would be the downside risk? You're probably at around 40.50 if you go through the 50-day. Before really money comes in, and there's a lot of money on the sidelines and investable accounts. So when we start to think about the risk on the upside versus the risk on the downside, it's actually a pretty favorable market at this point. Now, there could always be a black swan or something else, right? In 2020, we had that exogenous thing. There was really nothing in economic data to say anything was going to happen, and then we shut the economy down, which caused a major recession. So I'm not saying that it's impossible. I'm just saying from a technician standpoint, we're looking at a pretty decent risk-reward ratio whenever we look at the technicals.
Yeah, I think that's really a great point, because we're following the data. I was listening to one economist who was talking about his mantra is follow the data, not the news. And the reality is, just follow the news, you can become very fearful. But when you look at the data, that's showing you what's actually happening. And that's what we're trying to do here.
Right. Well, I think the big thing is the news is in the business of selling advertisements. And the only way to keep you glued to that screen is, or one of the best ways, I guess it's not the only way, one of the best ways is just to scare you enough so that you're going to sit through the commercial. You gotta take everything from the media. I think the advertisements are the most truthful part of the media after that.
Fear sells.
Fear does sell. It does. So if we start to look at our relative strength, what's working? Well, once again, growth is coming back into favor. And that's helping on the taxable side for sure. But we have made changes to the qualified side as well. So you probably saw some trades go through yesterday where we added and changed some of our emerging market funds. And we're tilting more towards growth even in the qualified account. And we were already fairly well tilted in the taxable account. But we're seeing that NASDAQ 100 large cap growth move up, as well as the S&P 500 move up. What's moving down? Equal weight. Mid cap, which has done very well for most of the year. Small cap is now about to cross over in the S&P 500. So we're lowering our exposure to these asset classes in favor of growth. And really with the qualified, we're happy to do that pretty quickly, because if things start to rotate the other way, we can unwind those trades where it's not as easy on the taxable side. We really like the Dorsey Wright program, where it talks about relative strength, point and figure charts, and other things, and we think they're very helpful. But I wanted to look at this slide compared to what we see. We see growth reasserting itself. We see cap weight, so the bigger names appreciating at a faster rate at this point. We see technology coming back in. So that's still not been picked up by the Dorsey Wright indicator. So it's one of the reasons that we like to have several points of data coming in to see what's happening and kind of test those to see what's better. And we've been moving to growth based on our proprietary program. Now, we do like to see confirmation. And if it's working correctly, we will see confirmation in the Dorsey Wright. But things that are working, that we see congruent data with Dorsey Wright is, if we look at commodities, it's the energy commodities that are working, precious metals not so much, which makes you question the whole inflation, maybe the Fed's right being transitory based on the move that precious metals have not been going up. They can be wrong. Markets tend to be wrong also. If we look at Europe developed, that's been strong. We're actually seeing Latin America appreciate rapidly. We've been a little concerned about kind of putting that into clients' portfolios because it just doesn't have the greatest risk profile. But as Mexico, we talked about demographics several weeks ago, whenever we looked at China and then we looked at Mexico. It could be that is an area that we want to get exposure to long term, because the demographics are certainly in favor, and supply chains are moving out of China that are coming ultimately to the U.S. and they're moving down to Mexico because it's actually cheaper labor in Mexico now than there is in China. So we're paying attention to it. We just haven't made any changes to the portfolio. And then if we looked at fixed income, high yield and convertibles, so basically equity like fixed income is working. But these are a little bit different than what we're seeing in our data, and our data seems to pick up the trends a little bit faster.
Yeah, well, it is good to have another source like this, which is confirmation, which is one of the tools that we use. But I'm really excited about your next slide, which is a new tool that you're working on. Actually,
yeah, so
you're going to elaborate on a tool that we've been developing using this metrics that we've had in the past, but it's going to be something really, really cool going forward.
Yeah, so we're still trying to get the scaling correctly, but it's our spider graph. And what it's doing is measuring the things that we think are important leading indicators, because there's a lot of information that is coming at you. And we're certainly trying to take it from a fire hose to make it into a garden hose. But then you also have conflicting information. So like the Dorsey Wright, you have technology that isn't appreciating on one indicator and it is on the other. So how do we start to sort through these things?
Great question.
And we're really trying to focus on systemic risk. You know, John, you were out. Bill and Bev were in from Rala yesterday, and they were talking about how much they loved the call. So a shout out to them. But Bill was asking, you guys have done great on the upside. What are you doing for the downside protection? So this is to try to answer. By the way, they were very happy that you were not in the state of Missouri and that you were in Florida. So what this graph is showing is going into 2007, most of the indicators that we're paying attention to were still positive. But we started to get some areas in that red zone. Yield curve and money supply, and we think these are some of the leading indicators. So they're the first to show signs. And we were already getting signs in 2007 based on these indicators that maybe there's a problem. Now, as a reminder, this is what 2007 looks like. So we get that 2007, 2008. It was an upward trending market, fairly flat. It doesn't end that much different from where it began, but it still trended upward for the year. And it was in 2008 that we started to really see some downward movement in the market. And we could see that in our indicator, we were in red zone. The only place that was not yet was unemployment and a recession probability. but they were quickly declining. Now, the money supply is very negative, and the yield curve is also negative. We would consider that really big indicators that there's risk in the market. We're actually working on some valuations for PEs and other things to include in here for market valuation to say, are the technicals rolling over? Is the relative strength rolling over? So that we can be ahead of a possible correction. And then we get into January 2009. And once again, I'm going to go back. So we see that 2009, early on, we bottom on the S&P 500. But we can start to see the yield curve go positive, meaning that the long end of the curve was higher than the short end, which is an indication that banks can loan, that the market is reasserting itself, that interest rates are likely to climb going forward. And the money supply was moving up. So this would be an indicator that the worst of it's passing, and similar to 2020, when we saw the money supply up substantially, and we called the V-shaped recovery, and many people were not. They were saying the economy is really hurting. We saw that as a leading indicator and really pounded the table to stay invested and actually add risk to your portfolios, despite a very unpopular message at the time. And it's these indicators that were helping us make that decision to say, well, ignore the noise. Here's the data. If the Fed is creating this much money in the system, it's going to get into capital markets. And whether the economy moves up in a robust way or not, capital markets will. Let's go ahead and add. So
based upon this, I mean, to Bill and Bev's question, is how can we protect ourselves on the downside? As you said, we've done great on the upside. How about the downside? And it looks like this is going to help us to better understand when to become more defensive.
Right, and we're doing some scaling, trying to get this correct. There's some mathematical puzzles that you have to solve since the red line is the same. So then you got to convert all the indicators to a standard measure so that they cross whenever it's negative in the red line. So we're working on that, and we're also working on back testing to say, well, was this actually a crucial juncture or not, or is there something else that we need to be paying attention to? But we're really hoping to get this out there soon by the end of the year, possibly even have it on the website so people can see that as a visual, because we think this really gives a good broad overview of the systemic risk in the market. So you could say, well, do we have one in the red territory? Do we have three in the red territory? What is the actual risk going forward? So we're excited to get this rolled out.
Very good. So if you just kind of summarize, looking back to our initial question of the day, are we at the top based upon all the things that you've seen so far in this data? What would you say to our listeners today?
So I think this month of July will still be a positive month based on the data. We had our first negative reading on money supply. We will wait for about 5 of them before we really get cautious. But that was one. Most likely, if the infrastructure bill passes, we'll see money supply increase because we don't have the money. We have to print it to bring it into fruition. So then that would reverse some of that negative signals. So we're just beginning to see some deterioration in the data, but it would be way too early to abandon the market, especially when we go back to seasonality. Yes, we have problems in August and September. We'll wait to see the data to see if there's confirmation, but July is usually a pretty good month. So now, once again, it's a gambler's fallacy to say, well, it's been red every time, so it's got to be red again, or it's been red every time, so now it's got to be black.
Past performance is not an indication of future performance.
That's the reason we're also looking at economic data. We want confirmation of those.
How do portfolios do?
The portfolio, they're doing great. Here's so tactical mutual fund is up 18.39% in the hypothetical model, while the benchmark's at 14.51. It was positive for the week. It's 1 basis point. I think we need to do better than that if we want to really have people raving about us, but it's positive. We'll take a positive any day. Yes, and all of our strategies were actually positive for the week. Tax sensitive, taxable wide moat, builder all have more growth in them, so they appreciated more. And we think that growth is finally reasserting itself. So we see that as as a good long-term, and we'd like to see some gaining throughout this third quarter on those benchmarks, so that whenever clients are logging into their portal, they don't see a squiggly line that's a benchmark and a squiggly line that's their portfolio, and that portfolio be below it. We want to see it back above, and we think we're in the right positions to do that.
That's great. Well, this has been a great presentation today, and it certainly answered a lot of questions that clients are having with regards to where we are in the market cycle, and are we at the top? So I think that was great to give us confidence. So as always, our objective here is to give our listeners our data-driven view based upon economic theory and current data, so that they can be better informed about their portfolios and have good actionable decisions that they can make regarding their finances. So thanks again, Aaron. It was a wonderful presentation. And if somebody wants to subscribe or forward this to a friend, what should they do?
Well, if they want to subscribe, they should click down on the subscribe button so they never miss an update, whether it's the weekly market insight or the daily 3x3. And while you're down there subscribing, make sure you hit that like button. Every time we get a like, we're happy, and it moves us up in the algorithm. And I don't know what that means, but I'm told by marketing I need to say the like button. So please hit that like button. And then if you click on the arrow, you can actually share this. And I think a lot of people would find this informative, because I think everyone has a question of, is this shoe about to drop? Ultimately, a shoe will drop. We just don't think it's right now.
Very good. Well, thanks again to all of our listeners today for joining in. And we hope that this was helpful and informative. And we look forward to having you back next week.